share with you the top 3 trade ideas using the Lizard strategy. Right? That's what I'm going to share with you. And you would have the chance to ask questions along the way. Please use the Q&A tab in your Zoom video and ask questions there. And then I will do my best to answer as many questions as I could. So that will be a live Q&A session right there. So just start to ask me questions and along the way as well. Okay? All right, let us start. Now, for those who don't know me, I used to work in one of the top Fortune 500 companies for 28 years. And I worked there as a group finance director in charge of a large business. And I have recently retired from it after 28 years. And I told the audience during the panel discussion 2 weeks ago, probably you have seen it. I love both jobs, right? The day job where I work in this company, quite busy. And I love the other job, which is option trading and training with our community members. So when I was younger, it's easier for me to juggle between the 2 jobs, so daytime and nighttime. So I slept very little every day, but I could do it. I could manage it. But now I'm getting a little bit older. I'm 54, by the way. It's a little bit harder for me to do both. And, in the corporate world, right, things getting heavier every year. So I thought that, hey, maybe I just focus my energy and effort on only one thing that I have a lot of passion for, which is option trading and training. And the Pira Profit community now keeps expanding. We have so many members in different chat groups, and people ask questions. Many of them are new, and I could totally understand why they ask those questions because I've been through it, right? I've been there before. So many years ago when I started learning option, I could not have a mentor or the coach who really helped me cut short my learning curve and also reduce my costly mistakes. But I paid my lesson with very costly mistake along the way, and I hopefully now I dedicate my time to help this community to grow. And you will see me along the way in different chat groups there when you ask options, the questions on option. The year at about $169,000 there, and I grew as of last Friday. It now $645,000. So essentially, I more than doubled the account in this year today, right? With still like a month and a half to go, right? Let's see how it end the year. But this one, the best performing account for me, 140% return on investment. The second account, this is also on IB. This one is relatively newer, so I have some additional money, so I kind of injected it in this account later part of the year. This managed to achieve about 22% year to date because I used part of it to buy US T-bill. Remember, I talked about US T-bill where it gives me like 5+%. So I use part of the cash to buy US T-bills, and T-bill gives you about 5%. So not like a significant return as you could achieve with options. So on average, it's okay. I think it's about in line with the market. I think a little bit more, maybe better than S&P 500 year to date, but it's okay. So this one is fine. On the other hand, I also have 2 Thinkorswim accounts. First one, this one I grew from 102,000 to about 144, which is about 42% return on investment as of last Friday. And you can see here, the white one is the one I started at the year end 2022, and the dark background one is the one that I just ended on last Friday. So from 102 to 144, that is $42,000 profit or 42% return on investment. on this particular account. So this account, I think I dedicate this one for one strategy, which is Crouching Moon, the one I introduced to you last year, Black Market webinar, and I follow up with the mid-year six waves event when I also reintroduced that one. I updated you with the latest results and also whatever latest thinking about the strategy. This strategy had been working very well for me in this particular year, so 2023, not only on this account but also on the other account as well. I have another Thinkorswim account. I call it account number 2, where I grew from 137K to 190K within this year. So that's almost 40% return on investment, right? And this one, it's a mixed account. I use it for many things. Some of them like, OTP trades, some of them for masterclass trades, and some of them for my own personal, but I'm testing different kinds of strategy as well. So this one is kind of doing fine. I think I got about double of the S&P 500 year to date, not so bad. And finally, I have the smallest account where the net liquid is about $75,000 only, but it did quite well. It delivered 24,000 profit from the 51 at the beginning of the year, so 47% year-to-date return. And for this particular account, I am still testing one strategy and one strategy only for using this account. So again, you know that I have some tests in the pipeline which I could introduce to you in the future, but this one is the one that I dedicated for testing one new strategy, and it's doing quite okay, right? So far so good. Let's see how it goes, and then if it works consistently, you know what, you could see the new one next year as well. All right, so this is a summary of my 5 accounts. So at the end of, on aggregate, right, you see 5 accounts. I got 70% return on investment, and they are all from option tradings, right? A little bit on the T-bill, but that's very small, because T-bill I just started about a few months ago, so the total return from T-bill is still small. Most of the profit has been from the option trading. Let me pull up the pen here so that I can draw something also. All right, so let's just continue. So far, so good. Okay, touch wood. We still have 1.5 months to go, and hopefully Santa Claus rally will bring some more money, right? Let's see. All right, let me get back into the power of the options, and I'm sure Adam had touched on it as well. So for investor, right, you can use option to do the hedging for your portfolio if you see some of the stocks gone too much, and then you want to protect the downside risk, or you can sell cover call to generate some extra income while you think the supply will retrace, right? For example, I believe I remember Adam did it on Nvidia and he did it on McDonald's. So he sold cover call when the price went up parabolically, right? For McDonald's, and he sold the cover call and he exited at the target price, which is quite significant. And after that, he got out of the position after the shares is sold. The shares are sold, and then he bought it back when McDonald's retraced. And I think it's a good way to get extra income from your investment portfolio, right? For those who are investors. Or Adam talked about selling cash secure put earlier today, where you sell a put option below the current stock price on fundamentally good stocks, so that you could either get the premium for free, right? 2% a month, so 24% a year, which is pretty good from the premium alone. And once in a while, you could get assigned, right? You could get assigned on the shares. You could own the shares. That means you get the stock at the discount anyway, and the stock that you own is the good one, the one with the solid fundamentals. It's not a lousy stock. So it's a win-win situation. Either you get the free premium or you get the good shares at a discount, right? Sometimes when you heard Adam say he delayed taking shares by closing the cash secure put and selling a new one, rolling it down and out to the further future. That's the way for him to delay taking the shares. That's a good way of trading cash secure put. I did it many times as well, right? So that's a very good way to get extra income for those who are more like investors kind of thing. But if you are a more traders, like active traders, there are different ways for you to bring it to the next level. You can generate profits in any market conditions. Right? Market goes up, market goes down, market goes sideways, doesn't matter. There are different strategies for you to use to make money in any market condition. It's like Swiss Army knives with so many tools and the knives and the scissors, stuff like that. You can use in different conditions, right? You can also trade or invest stocks using options. Adam, his preference is to buy the shares and hold for the long term, right? I use options to invest, right? I have different strategies to invest. Instead of using cash, I just use options because I use less cash to have the same exposure as if I'm holding shares. But the beauty of using less cash in this market environment, in this high interest rate environment, is you can get extra income from the cash that is sitting in your account, right? That's why you see across my accounts, the bigger ones are on Interactive Brokers, because Interactive Brokers are paying me 4.8% on the cash balance that is sitting on my account. Tinggal Swim pay me almost nothing. It's not about like advertising for IBKR, but I have to give them the credit of paying a higher interest rate for the cash balance on the account. Because the way I trade options, I use very little cash. In fact, I only has a big chunk of cash sitting on my account, earning a significant interest. Okay, I will show you one of my ID account later on, the cash that I'm having and the interest rate that I'm getting, right? You have an idea of the power of higher interest rate, right? People are afraid of, interest rate going higher, when the Fed will cut rate. For me, I just wish the Fed will never cut rate for my selfish purpose. Because I want the rate to stay high so that I can earn more interest from either T-bills is one, but that one is the secondary one. The main one is the cash that is sitting on my account. I cannot withdraw the cash because the cash is used as a collateral for my option positions, right? The way I trade options, I usually be the seller of option, and seller collect premium. So the strategy that I'm going to review today is one of them. When I collect cash in advance, I collect premium in advance, and that cash that I collect would generate additional income. That's one. At the same time, the option position that I'm in that trade also generate another income. So double incomes on the same cash that I'm having. So don't worry about the higher interest rate. It's actually a good thing. At least from my perspective. You can also use options to magnify your returns because you use less capital. And then you can also cap the risk, right? Some of the trade that I have, for example, I use diagonal spread, Pullman's cover call, or I use Pullman collar where I have a predefined downside risk. So I use less capital, that's one, but I also reduce my risk. So my trade won't have the unlimited risk kind of thing. You buy and hold shares, even if you buy and hold shares on fundamentally good stocks, once in a while, you will see that the market will correct, right, or sell off, then you could experience a significant drawdown on your investment portfolio. But with options, if you cap the downside risk, you don't have to worry so much about that because you know exactly how much is max loss of your position, right? So that's the beauty of options. Finally, you can also use option to define the win rates for your trade. The one that I'm going to reveal today has more than 80% win rate based on my actual result, right? Which I will show you later on. Last year when I introduced the CBS, the crouching bull, that one also have a high probability of winning. I think it's more than 70% win rate. I show you that the specific data during the six wave event during the mid-year, right? So those are the one I prefer. I mean, I always like to enter the trade with high probability of winning because that's exactly the concept of insurance companies selling insurance, right? So they have a high probability of winning. Most of the time, they collect the premium and that becomes their profit. Once in a while, occasionally, they will have to pay out the compensation or the pay off for the compensation because of accidents are happening. But that is rare. They have a high probability of winning. And that is why insurance business continues to be a very profitable business. And you know it. Warren Buffett like that business model. He invests a lot in insurance businesses, right? So I like to be in the insurance business where I sell insurance or premium and collecting cash. And now cash also generate additional income. Cash is not cash. Cash is now king, right? All right, so now let me get into a summary of options. Adam talked about selling put option earlier. So I just want to recap on what he talked about, right? Put option is a contract. The contract that allows the buyer of the put to sell 100 shares at the strike price on or before the expiration date. So let's look at these options here. Now, I prepared this slides. I prepared this slides about a week ago before I took off, right, on vacation. So the data was a little bit off. I know that CRM price has moved over the past few days. But when I put these slides, put together these slides, CRM price, the stock price, was at about 214. Keep in mind, stock price was at 214 at that time on the day when I prepared this one, right? So the data that I'm quoting here based on the data on about a week ago. So when CRM price was at 214 and I am interested in the put option, right? Put option for CRM, and the put option there expires on December 22nd, right? Which is about a month from now. And I looked at the strike price of 200, and at that strike price, the premium I could collect is $3.78. That means if I sell this option, I would collect $378 because one contract is equivalent to 100 shares, right? Which is fine, right? Because the stock price is at 214 and I sell a put at 200, which is 14 points below the current stock price. So I have a good margin for errors there in case the stock price drops. But if it drops less than 14 points, guess what? I would continue to keep this $378 premium as my profit at the end of the December 22nd. So that is the concept of selling insurance, right? You have some margin of error, and then if the time passes, nothing happened, no accident, nothing, then the premium that the insurance company collect will become their profit. So I'm playing the same business, the same action like the insurance companies has been doing, right? So if I like to sell this option. So when I sell 200 put, which is below the stock price, that means I'm selling out of the money put option. And CRM is a good stock, right? At the intrinsic value, I think it's about 240. So even in the worst case scenario, when the stock price collapses and drops below 200 by the expiration here, guess what? I will own 100 shares at $200 minus the 3.78. So my cost of owning the shares is only 196 something. which is very good because the intrinsic value is 240. And now I could own the shares at 196. Right? So it's a good deal for me. Either I get $378 for free, or I get to own the shares at the cost of 196. Yeah. So either scenarios, that will be a good deal for me. So because I'm talking from the seller of the put option here. So I call it the cash secure put, right? We sell the put there where I have the cash ready to take up the shares. I would earn the premium if the stock price stays above the put strike at the expiration, right? And in case the stock price falls below the strike price, which is the 200 strike price, at the expiration, I'm obligated to buy shares. At what price? At, is that correct? Something wrong here. I think I got it. 378. Yes, it's 378, not 478. Okay, so then that will be 196.22. So sorry for that. Yeah. So my cost of owning the share is 196.22. Now that's with the pros, or what is the advantages of this strategy is this. It has a very high probability of winning, because I will win in 3 out of the 4 price moves scenarios. If the price goes up, it's okay, right? Then I will collect the 378 for free. I will not be able to buy shares at a discount if the share price goes higher. Right? It's the same like when you sell insurance and there's no accident, there's nothing, business as usual, then you continue to collect the premium for free, right? And if the price goes sideways, I also get the same premium. If the price drops but not below 200, guess what? I continue to collect the same amount of money, 378. The only one scenario where I have to buy shares is when it drops below $200 strike price by the expiration, right? So I have very good probability of winning 3 out of the 4 scenarios of price movement. I would be winning. In this case, time decay works in the trade favor, right? So if I'm the seller here, it will work in my favor. Meaning if the time is passing and there's nothing wrong with the share price, every day a portion of the $378 will become my profit. Over the next 1 month, it will become my full profit, right? The 378, right? The last one, what if the share price drops below 200? Well, in that case,
I just finished the
I
fried
will
rice
own
with
the
the
shares, and I will own it at a large discount versus the stock intrinsic value. So either way, I would be happy. Now, the disadvantage would be, of course, my profit will be limited, right? It is capped at the amount that I collect, which is 378. I would not be able to profit more than that. And there's a unlikely event, but it could happen when the whole thing collapses. The whole thing collapses, right? I could have a significant drawdown when the stock price, let's say, cut by half, right? Now, I think it's a very unlikely scenario, but if even it happens, then guess what? I own the share at a discount anyway. So I would be happy with that. Yeah. So this is a P&L chart of the cash secure put here. The profit will be capped. The profit will be capped at the premium that I collect here when the stock price goes higher, or when the stock price stays stagnant, or if it drops, but not lower than $200, and below the $200, or below the break-even point, which is 196 here, then that is where I would start losing money. Yeah, so that's the P&L chart of the cash secure put. All right, so that's the first leg. This one I don't have talked about, so I just summarize it. Now let's look at the call option. The reason why I say you need to take a look at the call option, because the option, the Jade Lizard option strategy, has 3 legs. One leg is sell a put option, the one I just talked about. The other 2 legs involve call options. So you need to buy a call and you need to sell a call, right? So that is the one. Now, which one? So let's look at the call option first for those who don't know what call option is. Call option is also a contract between the buyer of the call and the seller option. And at that point in time, the broker shows me that, okay, this call option, you need to pay $6.73 or $673 for one contract if you are the buyer. If you are the seller, you would collect $673 if you sell this contract, right? Right. So I look at it, I say, very good. I want to sell this one. I don't want to buy because it's expensive. So if I sell this call option, what happened? Well, first of all, I will sell out of the money call, which give me some margin for errors. So in case the supply goes higher, but not beyond 220, this premium that I collect here will become my profit at the expiration. So I collect $673 premium, like selling insurance, right? And I hope the price won't exceed the 220 by December 22nd, right? If the price just fluctuate around the entry price, or even goes down, or even goes up, but slightly up and less than 220, guess what? I got 673 as my profit at the expiration. So it's the beauty of being the seller of the option here. So earlier we talked about selling the put, now I'm talking about selling a call. And you can do both. You can selling a put option and you can sell a put option and you can sell a call option at the same time and collect premium both sides. Now the problem with this one, before I get into the problem of this one, let me just to show you the what does it mean for selling a call option here. Let's say if I choose to sell that call option, right? That trade would benefit if the stock price stays below the break-even point. And what is my break-even point? My break-even point would be 220, which is the strike price, plus the $6.73. So if the stock price stay below 226.73 by the expiration, I will be profitable in this trade. Right? So it has very good profit zone because the price is right now at 214. It needs to go up like 12, 13 points to hit my break-even point. So I have a good margin for error there. Right? So if the price goes down, good for this one. Goes sideways, good for this one. Goes up slightly, it's also good for this one. But the problem here is I don't know if it will go way beyond the 226.73 or not. And that is a risk of the trade, right? Let's continue. Now, in case the stock price goes beyond 220 by the expiration, as a seller of that call, I will be obligated to sell shares at the strike price. So obviously you see the risk there. If the stock price goes all the way to 300, I need to buy shares at 300 and give it to this buyer at 220. So the risk on the upside is huge. Though the premium is good and the probability of winning is high, but the risk is unlimited, right? You don't have the limit on the upside. It can go to infinity and you could lose a lot, right? So in this case, I earn the premium, which is also my max profit, $673 here, if the stock price stays below the strike price by the expiration, right? So 673 for one contract. Now, the advantage, obviously, time decay works in my favor. Like I'm selling insurance. If not, there's no accident, every day I will realize some of the profit. And it has a decent probability of winning. Right? The problem, of course, is when the profit is limited at 673. The upside risk is unlimited. If the stock price suddenly surges or spikes to a very high level, this trade could lose a lot. And therefore, you cannot just sell a call option naked, right? You heard it from Adam, don't sell naked call option. Don't sell naked options in general. So in this case, selling this call option is one leg. I need to have a protection on the upside, which is the leg number 3 that I'm going to get into. So the leg number 2 here, selling a call option here, is like selling an insurance. But you know, insurance companies, when they collect money from you, so when they sell sell premiums to you, or insurance to you, they collect money from you. They don't just sit on the money they collect. They will need to find a way to cut the tail risk, they call it tail risk, or black swan kind of risk in the catastrophic event. What happens if there's a huge flood in the city? What happens if there's a wildfire? What happens there's a big, car crash in the highway? They need to plan out some catastrophic event, and when the risk is just too high, right? You know what? They do another action, which is to buy reinsurance. So insurance company, all of them buy reinsurance to cut down the high risk, low probability, but high amount of risk in those black swan event or catastrophic event. And you need to do this one as well. You cannot be complacent just selling call option here, because you never know. And especially with the earnings coming, high earnings coming, the stock price can surge to $300 and you could lose a lot. So in this case, you need to buy a reinsurance. And that is the leg number 3. Leg number 3 is reinsurance I'm talking here. So I'm looking at another call option, right? And same underlying stock, which is CRM, same expiry date, which is December 22nd. But I look at a higher strike price. That is where I need to buy, right? I need to buy to protect. When I buy the high strike, I cap the upside risk. Now, the good thing about the higher strike price is the premium is lower. And that is exactly what insurance company is doing, right? They collect a premium from you, from the insurance, and they use a portion of that premium, and they buy a reinsurance at a cheaper price, right? So that exactly the same concept. So I look at another call option here on CRM, same expiry date on December 22nd, but I look at a higher strike price. In this time, 225. Remember, the 220 is the one I sell, but I need to buy a protection on the 225, which is 5 points above that. And for that, I would need to pay $4.80, which is about $418. All right? So now just look at these two call options here. The one I sell, 220, and the one I buy, 225. That is, okay, first of all, if I get into it, the third leg that I'm getting, I buy here, the reinsurance I'm buying here, will profit if the supply goes much higher, which is good. That means I cap the risk of the one I sell, right? And so let me skip through it and let me show you the combination of the two legs. I sell a low call and I buy a higher call. Now, in the curriculum, we do teach this strategy and we call it bear con spread. A bear con spread is a combination of the leg number 2 and the leg number 3 there. Where so it's combination of selling a call and buying a higher strike call, right? So in this case, I would sell 220. I collect $673. And to cap the upside risk, I will need to buy 225 call. And I need to pay a reinsurance premium at $4.83. So net, I would still collect a premium of about $190 for one contract, right? So between selling and buying a reinsurance to cap the upside risk. So I'm happy with 1.9 within a certain limit of risk only, correct? And then this is the concept of selling insurance and buying reinsurance to cap the risk. The advantages of this strategy is, first of all, it still has a very high probability of winning. Because remember, the 220 call that I sell here is still out of the money and it's still above the current stock price, 214. Right? So even if the stock price goes up a little bit, it won't hit that strike. And I would still be winning on that selling call, right? So high probability of winning. time decay works in my favor because net I'm still collect the net premium credit. Then every day passing, it will bring some profit for me from the 1.9 there. After like 30 days, the 1.9 or 190 will become my profit. Okay? The disadvantage of this strategy is, of course, the profit is capped at the 190 only, so I don't get the full amount, just 190, because I need to pay to buy reinsurance. And it's a typical P&L chart here. I would collect $190, but my max loss is more than 190. So this is a max profit, 190, but the max profit is 310. So it's more than the max profit. Whereas a 310, well, my max risk is the strike difference, the $5 difference there. That is my max risk, minus the 1.9, so that is 3.1, which is $310. That's my max loss. So that is a little bit unfavorable risk-reward ratio. So that's the trade-off. I have high probability of winning, but if I lose, I could potentially lose more than my max gain. Now the thing here is, I will never let it lose 310. Adam also mentioned in his previous webinar, when the strike price hits my short call here, 220, I will cut loss. And then at that point in time, the loss would probably be half of that. 150, 100 or 60 kind of thing. Then I will not lose 2 times, right? So that's the discipline we need to have. We need to have that discipline. When the trade hits some stop loss, we need to get out. Now I'm talking about this bear call spread only, not the trade lizard. The trade lizard, if the share price goes beyond the strike price here 220, actually you don't have any loss. You have profit. That's the beauty of combination of the cash secure put and the bear call spread. You know, that's the more you learn option, the more you find it so powerful. So if you only do the sell call, well, if the share price goes up, you'll be losing money, right? But later on, when I show you the trade lizard, if the share price goes beyond the short call here, well, you make less profit, but you still make profit. That is the beauty of the options. Okay, let me continue, and I show you the chart later. Now, how to construct a trade lizard trade? So the strategy name is trade lizard, and to be transparent, right? It's not something I invented, right? The strategy is not like my own invented kind of strategies. Like Crouching Moon is the one I invented. Skyfax is the one I invented. Earnings Sniper Spread is the one I invented. So Boonbang Collar, Boonbang, I invented a lot of strategy, but this one is not invented by me.
Filipino.
However, the trade lizard that I'm teaching will be a very specific version of trade lizard. So trade lizard is a big concept. It can be very flexible, but the one that I'm teaching will be very strict on the entry rule and exit rule. So in a sense, my own version of trade lizard, right? Now, who created trade lizard? Okay, first time people heard about trade lizard strategy, that was when 2 ladies, Jenny Andrews and Liz Durkin, they both mentioned it on tastytrade. And then the concept came from there, I think many years ago. But they talk about the concept, the broad concept, without any specificity on entry rule, exit rule, delta of this, delta of that. But the one I'm teaching will be very specific, and that is my own version, right? So basically, trade lizard is a neutral to slightly bullish strategy, right? Neutral to bullish strategy that involves 3 legs, and all 3 legs have the same DTE, date to expiration, right? The December 22nd or something like that, right? So leg number 1, sell an out of the money put, which is the put option that is below the current sub price. So like CRM, current stock price is 214, so I would sell 200. So well below the current stock price. So it's a cash secure put. Number two, leg 2 and leg 3 combined, it's a bear call spread, right? Sell a call and buy a higher call to cap the upside risk, and that is a bear call spread. So 3-legged trade, right? And if you construct it in the platform, you will see the shape of the P&L here, right? The shape of P&L here, and you see 2 lines. The blue one is the P&L at expiration, and the pink curve is the P&L right now if I enter the trade today, right? So for those who are not familiar with this P&L chart, the 0 line shows you the profit or loss. Above 0 line is a profit, right? Below that will be loss. In this axis, that's a stock price, right? Stock price on the x-axis, right? So now, if you construct the trade result, trade that I'm going to talk in detail later, correctly, if you do it correctly, it looks like this. The trade would have no risk on the upside. And you see here, if the stock price goes much higher than the short call, or even beyond the long call, guess what? You have no risk on the upside. You will still make some small profit here, right? There's no risk on the upside, unlike bear call spread, where you do have a significant upside risk. This one, you have no risk on the upside. And you have a huge profit zone. By right, you should have something like between like 70 to 80%, and most of the time it's close to 80% probability of winning. And there's only about 20 plus percent chance that you'll be losing in this trade. Yeah, high probability of winning, and the profit is quite decent. Profit is quite decent. We get into it later. And huge profit zone, no risk on the upside. And if you translate this profit into return on investment, it's a very good one, right? Just bear with me. I will show you all the details later, all right? Just show you the broad picture first. The shape of the P&L, it looks like the lizard, right? With the hum, no risk on the upside, risk on the downside only at the expiration. But after you enter the trade and the price suddenly drop, then you would incur some loss. But this loss will turn profit if the time passes and the price stops declining. Then you would be turning the trade into a profit, right? So let's get into the detail here. Now, the trade would have more than 70% probability of winning if you construct it correctly. Should have more than 70% chance of winning. But it has no downside protection though. Every time you enter a trade with a cash secure put, that means you need to have cash ready to take the shares in the worst case scenario. Therefore, you should do it on fundamentally good stocks where you don't mind owning the shares at the cash secure put strike. Like CRM, the intrinsic value is 240. I sell cash secure put at 200. So that means I don't mind owning the share at $200, which is a significant discount versus intrinsic value. And then I collect some premium that reduces my cost even further. All right, so before you get into the trade, I want you to take notes, right? Take note on the checklist. I take a lot of notes and ask me questions along the way. All right, so first of all, I think you need to be ready to enter the trade. First of all, ideally, you should use trade lizard on fundamentally good stocks only, and fundamentally good stocks that are undervalued, right? You don't want to do it on speculative stocks, because speculative stock tends to drop a lot or move a lot, right? Gap up, gap down. Now, gap up in this case, you don't have risk, you make less money, but gaps down will be a problem, right? You don't want to do it on lousy stocks that have a good chance of being, gapping down. You want to do it on fundamentally good stocks, because in case it goes down, you own good stock anyway, and it's undervalued, right? So avoid highly speculative stock, though they have very good premium, but avoid them, right? I done few hundred trades already. those are losing. Most of them are on speculative stocks. Again, so you asked me why I do it. I did it on speculative stocks because it's still a test to me, right? So I told you past 6 years, past 6 months rather, I did 250 plus trades. So when I started out, I did not know whether this one can be used on speculative stocks or not, or it can only be used on good stock. And upon reviewing the losing trade, I realized that most of them has something to do with speculative stocks. So that's why if you avoid speculative stock, it will improve the probability of winning even better, right? Number two, from the technical standpoint, I mean, fundamental is one, but technical is also important. I would avoid doing it on the stock that shows no signs of stopping. The declines show no sign of stopping. There are several stocks that you can easily plot, and you can see that the stock price continue to move down like there's no tomorrow, right? And there's no sign of stabilizing, consolidating, or due for a rebound or something. Avoid those, right? Even if it is on the fundamentally good stock. Even on fundamentally good stock, don't do this. It's a trade. It's not an investment, right? Then avoid, because the trade is only a few days, and you get in and get out. Don't trade. For trading, it is based on price action a lot, right? On the chart, on the pattern, technical pattern, and sometimes fundamentally, fundamentals of the stock is not is less important than the technical setup. All right, I've seen quite a few fundamentally good stocks that are like heading lower every day. I mean, there was time when Hershey, for example, dropping like crazy. Now it's stabilizing, good, right? But there was time it like heading lower and lower, like Estee Lauder, like Alibaba, for example. There was time like that. So when you look at the chart and from your bare eyes, you can realize that, hey, this one looks like still no diving, right? Then don't touch it. Don't touch it, right? Only when the stock price start building the base, consolidating, and ready for a rebound, that's good, right? Because the trade lizard, remember the profile of the trade, it has no protection on the downside. It's okay if it goes down a little bit, but not significantly. And it has no risk on the upside. And it's perfectly fine if the stock price consolidates and goes sideways. The longer it stays near the entry price, the better. That's where you get the max profit, right? So the technical setup is very important. Now, the ideal DTE, day to expiration, based on my hundreds of trades, the ideal DTE is between 4 to 6 weeks. Between 4 to 6 weeks. Again, the general trade lizard doesn't have a concept of what is the DTE and stuff that you need to figure out your own. But I have done hundreds of trades and I filter on the criteria to come up with the best optimal entry rules for you here. And I found that 4 to 6 weeks are the most optimal entry time, right, for the trade. Again, three-legged trade. Now I'm getting a little bit more detail on what put, what call, right, that you buy or sell. For the short put that you sell at 25 delta. Don't sell higher delta. When you sell higher delta, you get more premium, but will be riskier. The lower delta you sell, the safer it is, right? You want to sell lower delta, which is much lower than the current stock price. You still collect a good premium, but if you are a little bit greedy, you raise the delta to like 30, 35, that will have a significant less probability of winning. Yeah. So don't go for that. Just keep at 25. Sometimes 25, 26 is fine, but don't go like 30 or 35. Okay. Lower is better. So if you can sell like 22, 21, 20, it's even better. Especially if you use this one for earning. When it uses this one for earning, meaning the DT crosses the earning period, this one you can still use, but play safer. Sell 20 delta, say, or sell like 19 delta, or sell like 18 delta. You know, because with the earnings, even if you sell like 20 delta, the premium is still very good. So that's the beauty of doing this one during the earning period. Your profit zone will be even wider. Yeah. So that's a short put, 25 delta or lower. How about the short call? Short call, 45 or lower. 45 lower because you don't want to sell too close to the current stock price. You know, if you sell 50 delta, that will be at the current stock price. You don't want it. You want the profit zone to be a little bit wider to the upside. So if you can sell a higher, the lower delta, which is the higher strike price, that would be better. So ideally, you sell at 45 delta. But sometimes if you can sell at 40 delta, you collect a good premium. That's okay. That's even better, right? But no, please don't go low. Please don't go higher than 45 delta. Meaning you should sell further out from the current stock price. Now the long call is not a specific delta thing, right? How do you select the long call? This is very interesting. The long call will depends on the spread. So here you need to simulate manually. You need to try and error, right? You see, like you buy a long call $2 above, or $3 above, or $4 above, $5 above the short call. You will select the one that has this criteria. The credit that you collect from all three legs combined here, the premium you collect from the three legs combined here, the premium, the net credit, needs to be equal or greater than the bear call spread, right? So for example, this one, for the CRM, I sell 200 strike, right? For put option. For the short call, I sell 220. Remember that one earlier? I showed you this. And for the long call, I need to try to test different scenario. And finally, I found the good one that is at 225. Now between 220 and 225, how many points is it? 5 points, right? So therefore, the whole trade here with three legs, you need to collect at least $5. If you can collect $5 or more, then when you show the P&L chart, it has no risk on the upside.
Boy is quite nice.
Yeah. If you could collect $5 or more, in this case, you have no risk on the upside. So in summary, right, the bear corns within the long corn and the short corn here, the spread between the two has to be, the credit you collect should be higher than the spread. Yeah, so that you have no risk on the upside. Right? I will show you the detail with the data from the option table later. Right? You will see it clearer. Another criteria which I often see no issue, but at times you need to check this one because it cannot be this one. I will skip the trade as well. The max return on investment, which is the max profit divided by the max capital, right? And the capital for me is based on the buying power that the broker blocks me on the trade, or the margin on IBKR. They call it margin. They block margin for me, and that's for me is the capital. If I can get the max profit, which is the premium I collect there, divided by the margin, and that gives me more than 10%, the trade is good to go. If you get only 8%, 9%, skip it. Right? Minimum 10%. Often I get like 15% or even more. Right? But minimum is 10%. Now, the trade would have a break-even point at the very low end, and therefore the probability of winning is very wide, very high. Now let me show that one to you on the option chain here so that you understand what I just talked on the theory part. First of all, you look at this stock. Yeah, is this CRM here? There's CRM in the corner here, so it's a CRM stock. And for those who don't know, not familiar with this chart, basically you have the strike price in the middle, and you have the call options on the left, and you have a put option on the right. Right, so then I choose DT here, the date to expiration, which is 22 of December. Right, so here's a trade that I'm planning to do. based on this data. Number one, that's the trade has 3 legs, right? Same DT in this case, the 39 days to expiration. You see the 39 days? That's the date from now to expiration, right? 39 days is well within 4 to 6 weeks. 4 weeks is like what? 28 days. 6 weeks is like 42 days, right? So this is within that. So from the DT standpoint, this is good. Share price, as I mentioned, when I put up this PowerPoint together, the share price is near $214, so $213.63. That was the share price, the stock price. Now, leg number one, I would sell a lower put at 200 strike price. You see the 200 strike price here, which is below the share price, 214, right? And that is out of the money put. And you look at the column called the market price. If I sell that put, I would collect $2.78 or $2.77, which is $377, which is $377 per contract, right? So that's the first set of premium that I will collect. Number two, I will sell leg number two, which is the 220 call option. This time I sell call option here, and I would collect this marks here, right? I would collect $672 one contract, right? And if you look at this, because the share price is at 214, both 200 put and 220 call are out of the money. So the price is right in the middle of the two, right? That is the second leg. Leg number three, because when I sell call option, I would expose myself to unlimited risk, right? So leg number three is to buy reinsurance. And in this case, I will buy the 225 call option to cap the upside risk. Right, this is my reinsurance here, and I need to pay $483 for the reinsurance fee. Yeah. So in this case, what you see here, this is what I collect, this is what I collect, and this is what I pay. I need to pay, right? So if you combine the 3 legs, collect, pay, I would collect the net credit of $5.67, which is $567 for one contract. That is my premium I collect upfront. This is a insurance company selling and get the premium upfront, and that would be my max profit also. And you see here, I get it upfront. I mean, it sits in my account and it earns interest rate on it, right? For the interest rate on the 560 is small, but imagine if you do many of them on a big account, it could be a meaningful amount of money, right? And if you do that, well, how much is the buying power in this Thinkorswim or TD Ameritrade? They will block me. Well, they would block me about $3,225 as a buying power.
Like
in reality, when I execute this trade on my indirect broker, they block me less buying power because I have a portfolio margin on IBKR. So they block me less buying power. So the return will be even better. Thinkorswim, they don't, I mean, the one in Singapore doesn't have portfolio margin, so they block 3,002 for this trade. Even with that, that translates into a pretty good potential max return on investment. So if you get 567 divided by 3225, that is 7.6% return on investment. And this is not per year, this is over 39 days, right? So if you analyze it, it could be a very big number. Right? So the third one I want to focus on is the third one. You buy a further out the money call as a reinsurance here at the strike price where the credit that I collect here would be more than the spread of the 2 legs of the call. right? Between the 220 and 225, $5 spread. I collect $5.67. That is very good. That means I have no risk on the upside. If you collect less than 5, then there will be a small risk on the upside. Yeah. Hope it's clear. All right, so here's the P&L chart. Once you plot it on the simulation on Thinkorswim here, you will see this kind of chart, which I showed you earlier. But I just want to zoom it in here. 3 legs here, remember? Sell a put option. Let me change the color. So I will sell a put option here, right? $200, 200 strike price put. Then I sell a call at 220 call options. And to protect the upside risk, I buy a 220 call option. Net, I collect $567 for a credit for the trade for one contract. So that is the trade itself. Now, in terms of the price potential movement, right? Current stock price is here, 214 kind of thing. It near in the middle of the profit zone. You can imagine that if the share price goes up or stays sideways, what happened? Well, the trade will make profit, right? So you have a huge profit zone there. In this case, almost 78% chance of winning, yeah? And you make money if the stock price, the best scenario would be if the stock price stay between 2 short strikes. This is a short put, and this is a short call, right? If it stays here until the expiration, you get the max profit, which is $567. You make less profit if it stay in this range between the break-even point and the short put strike. You would be still break-even, making money if it stays here until the expiration, but the profit will be less. On the other hand, if the stock price goes higher, if it stays within this zone, you still make some money. But if it goes too much higher, you will still make some money, but the profit will be smaller. So obviously you see that there's no risk on the upside. And that's total profit zone, you have 78% chance of winning in this trade. And you have about 22% chance of losing money in this trade, right? So if the stock price drops below the break-even point, so in this case, the break-even point is this. So how you calculate the break-even point? First of all, the max profit is easy, right? That's 567, which is the zone between 2 short strikes here, yeah. The 220, other 200 and 220, yeah? That's the max profit. How about the break-even? The break-even point will be equal to the short put strike, which is the 200 here, minus the $5.67, which is a credit I collect. So that will be the break-even here. Yeah, that is 194.31 or something. That is the potential cost of owning the shares. Think about it. In the worst case scenarios, you need to own the shares at that strike price or at that cost, which is okay. Current stock price is 214, which is already undervalued, right? Versus intrinsic value of 240. And now, if you could own it at 194, which is even lower than the current stock price, not a bad deal at all. I think it's okay, yeah, in this case. So you can imagine that it's a pretty good deal here. I have a very good chance to collect the profit, which is a premium here. But in the worst case scenario, I could potentially own the shares at the cheaper price. Now, later on, I will show you different price scenario and when to cut loss and when you take profit at the end, right? Now, this is the exit rules that I'm talking about. Now, in the best case scenario, if the price continue to stay within the entry range, it's about here, between the 2 short strikes, the time decay will bring profit. You see the pink curve? That simulates the time passing. After about a week or so, or 10 days, or maybe 2 weeks, you will start seeing that you could would make half of the max profit already, or sometimes you make 2/3 of the max profit, right? So for the $567 max profit, you could get 280, or you could get like 320 something. That is very good. You don't have to wait for 36
Wrong.
days to
but never
get
right.
the remaining value.
So long.
In that scenario, I would take profit early. If I could get half of the max profit or 2/3 of the max profit,
Longer again.
especially when profit comes very early after a few days or a week, just take the money and run. Use the capital for a new trade, because that's the better way for you to utilize your capital. Don't hold the trade until the expiration, because the remaining time is long and the remaining value is lower. There's no point to do it. You already got the most profit of the trade. Take the money, run. Release the buying power, release the margin, enter the new trade. Yeah, so this is the best scenario. I normally take profit between these two. 1/3, half to 2/3. That's 50% to 70% kind of thing. That's where I would take profit. Now, scenario number 2. What if the price falls sharply? Well, this is a bit tricky. Well, technically, you can own the share at a low price, but in this case, I treat this as a trade. In this case, I do cut loss. I don't hold on to the trade, because these strategies, the best way is to get in fast and get out fast. Because if you hold on to it and wait for the stock price to recover, it becomes investment and it could take a long time. I find out that if you cut loss early, the loss is small and you can release the buying power for the new trade. Because the strategy itself has a very high probability of winning already. So occasionally, when you get something hit the fan, get what? Just accept that, okay, this one is a bad one, and you cut loss and move on. And I usually cut loss when the stock price drops below the short put. So in this case, the short put is 200, remember? And it drops below 200, then I cut loss. Sometimes I wait a little bit longer, like I wait for the day to close. So sometimes I cut loss between the break even and the short put. But most of the time I cut loss near here, right after it closed below the short put strike. Because if I cut loss at that point, the loss would be very minimum. So because of this trade, the max profit is what? $567, right? $567. If I cut loss right now, right after I enter the trade and the price drops already, I would cut losses about 250, right? Yeah, 250, 280. So half of the max loss. So it's not bad. It's not bad if you cut loss early. Now, if you wait, and it could snowball, right? And the loss will be significantly higher as the price continues to drop. So, I mean, I tested different scenario. I found out that the best way to exit when the price goes against the trend is to cut loss between the short put and the break-even point, right? The sooner is the better. Last scenario, if the price suddenly moves higher, especially after earnings, it jump all the way up, guess what? You don't have any risk on that side. You just make less profit. So in that case, if the price goes beyond the long call, which is a 225 here, I would close the trade early for a small profit. In that case, I would still make a small profit, maybe like 15% of the max profit or 10% of the max profit. That's fine. That's fine. But it's still profitable, no? Because if I don't, the longer it stays here in the pink curve, you see, the lower profit will become, right? You see, if the pink curve here stay here, and then the time is running out, it will go down and it merges with the blue line. The blue line is lower than the pink line. So then that means I will make less profit. I would rather make more profit, right? So then I just close the trade early and happy with the small profit. And the good thing about doing it is you release a buying power, release a margin for a new trade. Yeah, there's no point to leave, because once the stock price has a very strong momentum and it goes up, it's very hard for it to go down, right? I mean, it's hard for it to suddenly, because it goes up because of the good news. And the good news will last for a few weeks, right? hardly I see the company release good earnings. The stock price went up, and then the day after they won the next quarter guidance or something. It never happened, right? So the momentum will carry on. So chances are the stock price will continue to go higher. So in that case, better just close the trade and move on with the small profit. Now, key benefit of Trade Visa: if the stock price moves moderately or stays within the profit zone, that is the best scenario. The trade will do very well. Time decays work in the trade favor. So the more time decay, the more time passing, the more profit it will bring, right? Number two, if the stock price rallies beyond the short or the long con strike, the trade would still be profitable, though the profit will be smaller. Take it, run, right? Number three, the trade has, of course, in the third scenario, when it drops, cut loss when it drops below the short put strike. The trade has a very good probability of winning, right? I'm talking benefit here. And because it's a fast in, fast out kind of trade, I can recycle the capitals many rounds, and hence it will improve my annual return on investment. Yeah. And the last one, the one I mentioned earlier, the premium that I collect upfront, or the cash I collect upfront, could earn extra income, which is the interest as well. Now, I promised you earlier that I will show you the interest rate, interest income that I collect from one of my account. I don't know, is it still here? Here you go. Okay, here's one of my IDKR account, and then you look at the account here. You look at the month to date interest, which is this month. So this month is November, right? And we have only like 90 days in the month. And this account alone, I already got $3,700 or $3,600 for the interest. So imagine that this account, by the end of the month, I would collect about $5,000 because I have a lot of cash in this account. So that just shows you the importance of having a good cash balance there in your account. And the way I trade, I normally collect premium upfront, and hence sitting on a big cash amount there, and then it earn interest for me. So imagine I got $5,000 per month interest rate alone, not talking about the profit from the trades. And I have another IB account with the same size. That's $10,000 a month. That's why I retire early, right? So just in case you don't know, just joke aside. There's many reasons, but this is the good way to earn money while the money is sitting in your account. And a lot of you complain about IBKR, but I find IBKR actually is a good thing that happens. Not just IBKR, because Fed keep the rates high, and this happened to pay high interest. Where I love, right? All right, so now the last thing, I do not suggest that the cash I'm having there just come from the Trade Visa. It comes from many different trades and different strategies. Hopefully in the future I can show you some of them. I have some in my pipeline, in my toolbox as well. But I'm mostly an option seller where I collect premium upfront, and that's cash there coming from those trades, which give me a good income. The interest income alone, even before the profit from the trade, which is a good thing that I like. Okay? So go back to this lesson here. Now, having said that, is there a risk or watch outs that you need to pay attention to on the Trade Visa? Of course, there's every time when you sell a put option without buying a reinsurance for the put, that is undefined risk. All right, undefined risk, meaning if the stock price collapses, you could lose a lot. Yeah, just put it out there, very transparent. Be aware of the risk. So therefore, don't do this on highly speculative trades, the highly speculative stocks. Only do it on good stock, right? If the price drops sharply, the trade could experience a significant loss. So in my 250 plus trades, as a few that I lost big, right? I lost big, but luckily, I mean, by design, the number of big loser is very small. I have only few of them. Right? So that's exactly the same concept of selling insurance. I mean, most of the time I collect premium for free. Once in a while, I hit the fan. I mean, something hit the fan, I have to pay a big lump sum to pay off. Exactly that's how it works, right? So just be aware. As long as you are okay with that concept, you don't have to worry about the temporarily loss. Sometimes it happens. Now, if the price falls below the put strike, trader could consider cutting loss early to avoid a larger risk potential. So it's important, that one, because you have no reinsurance on the downside. It's important to stay disciplined to cut loss on time. That will limit your potential bigger loss. Now, among the 250 trades, I did have some trade where I let the trade go and the price falls even lower, and from that experience I came up with this conclusion that for those trades, if I have cut loss early, I would have avoid those big losses, right? Number 3 here, as usual in any strategy, not just trade lizard, right? Don't overtrade it, right? Don't overtrade it. You need to diversify your portfolio, your trades with different strategies as well. Even Crouching Bull did very well for me this year. Don't overtrade it. You need to have a good combination of different strategies. And don't overtrade it. Don't trade more than you can afford. Especially at the entry, the broker may block less buying power for your trade. They don't block the max loss. The max loss is when the stock price goes to zero, right? So they don't block you the buying power for the max loss, but they block only not the small part of the capital, right? But that buying power would not be the same. It will change, especially when the stock price drops. If the stock price drops, they will block more. If the stock price rallies, they will block less because there's no risk on the upside. So it could work either way. In summary, Trade Lizard is a high probability strategy. I show you at least 70%. In reality, I show you later, it's more than that based on my trade result. My preferred version of Trade Lizard. Again, Trade Lizard is a big concept. That's not invented by me, but I fine-tune it. I test it out, and I filter those criteria, and I make it very specific for you to follow this version of my Trade Lizard because it has been proven, very consistent result, and high probability of winning, right? My version of Trade Lizard is you sell Cassidy put at 25 delta or lower, and you sell a call option at 45 delta or lower, meaning higher strike, right? And then choose the long call in a way that the total credit you collect from the trade will be more than or equal to the spread of the call, so that you don't have
It should be.
upside risk here.
You can
Right?
test.
However, watch out, Trade
It should be
Lizard has no
soft.
downside protection, and hence
very
it's
soft.
important to cut loss on time and stay disciplined with that. Otherwise, the loss would be significant if you let the price snowball, right? Okay, here's the result of my Trade Lizard trade here. This is more updated than what we show you on the videos because this is up to last Friday close, right? So because I added a few,
So far,
and then
should be
among
soft or
new
what?
trades there,
No,
most of
buy
them are
it.
winning and
Buy it should be.
a couple are losing, right? So here's the most updated data here. So as of now, after 6 months,
Then switch off.
so I started out by
Switch off.
end of May, right? So 6 months now, I have done 258 trades. And by the way, I have closed most of them. I think I have only 2 or 3 left
Yeah,
open.
you can try.
I have closed most of them
Very
already.
nice.
Among the 258 trades that I have done so far, including the few open, the few that are still open, only 34 of them are losing trade, and 224 are winning
No, of course,
trades.
it's something like
That translates
chestnut
into
Bye-bye.
87% win rate for me. 87% win rate. In terms of total profit and loss, the winning rate, the winning trade here, the 224 winning trade generated $68,000. The 34 losing trade incurred $31,000 loss. So net of the two, for the 250 trades, 58 trades, I earned $37,000, $37,600 for that 258 trades. Now, this is something that you may scare you, but I tell you don't have to worry about. The buying power or the capital or the margin that I used, the $1.4 million, first of all, don't be scared about this number. This is a cumulative number. This is the cumulative number of the 258 trades combined. Yeah, combined. But you know that I don't need to have that big account to do 258 trades, because on average, I get in and get out within 12 days. So get in and get out within 12 days on average. So that means I keep recycling the trade. The 1.4 here is a cumulative numbers. So for you to understand how much I need to do a similar trade, right? Let me do the math here. All right, so let me do the math for you. 1,4,2,1,8,01. That's the cumulative capital divided by 6 months. Right, I've done this for 6 months now. So on average, I use 236. But because in each trade, I am in the trade for only 12 days. So then for this one month here, I divided by 30 days, a month, right? I have 30 days and time 12. So on average, I just use $95,000. $95,000. Call it $100,000. You just need $100,000 to do this 258 trades and get in and get out, keeps recycling the trades. In fact, right now, I have only 3 trades open, which use less than $10,000. And the reason for it, because I know that I'm preparing for the live trade hunt where I will enter a few live for you to see also. So I expect to have some more coming, right? So, but on average, I use about $100,000 only. That's why we say my crazy 100,000 tests or that I've been doing over the 6 years. Actually, I use less than that, right? So now, in terms of return on investment, if I get $37,000 here divided by 1.4, I got about 2.7% return on investment per trade. Per trade. Looks small, right? Looks small. But remember, per trade, and per trade means only 12 days. So imagine if I do this one, I convert into per month. What do I have? Sorry, I need to open up my... okay, let me do this one on my computer here. My calculator here. So now let me do the math here. 2.7% over 12 days. So I divided by 12 days and time 30 days a month. So if I convert the return on investment into per month, I get about 6.8%, 6.75%. Right? So it's much better than just selling cash secure put. Right? Earlier you heard from Adam, cash secure put gives you about 2% a month. This one could give you 6% or 7%. 7% a month, which is a better one. And if you analyze it, it will be even a bigger number, right? So if you analyze it, so here's a summary. Profit, $37,000 over 258 trades in 6 months. A win rate of 87%. Average 2.7% return on investment in 12 days. Right? So per month is about 6.7% per month. And I use less than 100K capital. And if you analyze the 6.7% a month, into a year, you get about something like 82% a year. Now, I tell you, I don't know about you, but for me, if I get 82% annualized return with 87% probability of winning. And by the way, the 82% here already consider the losses, right? So it's all in, right? But if I can get this high return on investment with the high probability of winning, I guess this is something I like to do very often. All right, so hopefully it's interesting and then gives you some idea of what option can do, right? To show you some of the testimonials of our students. So this is from Tony. I believe Tony is in the US. So Tony said, you have given me the tools to change my life. I have nickname for Bang, so he called me Bang Bang because he's a super option trader and coach. I'm 72 and have more than double my account in 8 months, something I only dream of, right? So Jason also from the US, he said, I made more than 10K in options trading today. I think so he said that I think during the bear market where his portfolio, long-term portfolio lost money, but he made more money from the options to offset. So very good, Jason. This is from Michael. Right? So Michael also used option to hedge his portfolio during the bear market. So he said, on my knowledge came from Bang and Adam and Bang, even though the market is going down, my account is about staying the same because I'm because of hedging. I'm not worried about the market falling when I'm sleeping. You see the power of option, right? You can trade when the market goes up or goes down or goes sideways. So Michael make the profit from market going down. Let me skip through this. Hannah also make good money. I have profit every week. It's too good to be true, right? So again, the option mastery package that we're offering you today on a very special event on black market here would have 2 levels. Level 1, option, they call it iron shell, right? Where this is the basic option levels. Adam and me jointly developed this one, focusing on more investors now moving to options, using option to boost the income, to boost the return on investment. So it's a little bit more on the investment side. So we start with the basic concept of option trading. We go through everything. Even if you are completely new from option trading, no worry, we cover everything, right? From zero, right? We also talk about how to set up the charts and tools to trade options, both in Thinkorswim and also in IBKR, right? You have it both. We explain how long calls and long put works. With cover call, with the portfolio of stocks you have, how do you generate extra income, right? We also talk about how to use option to hedge your portfolio in case you think the market is going to go through a retracement, right? You can use option to protect your portfolio as well. Lesson 6, this is what Adam talked about earlier, right? Selling cash secure put, getting 2% a month, or potentially buy stocks at a huge discount. Lesson 7, where we talk about bullish strategy using the vertical debit spread. So for those traders who have smaller accounts, this is a good way for you to trade because the trade would cost very little and it have a significant upside potential, right? So it's a good bull call and bear put kind of spread that you can learn from there. Bearish strategy, same thing, right? Call, now put, right? And then number 9, this is a dynamic of 2 strategies. You can start with cash secure put, and then one day you get assigned with shares. You use the shares to sell cover call. And that's what we call the cash flow wheel. Very interesting lesson from Adam there. We have 2 bonuses. First one, we have the basic technical analysis for you to, have some basic